In India, many organizations offer gratuity benefits, a type of defined benefit plan where, although the benefit formula is predefined, the timing and amount of payments are uncertain. Effective management of this uncertainty often involves setting aside dedicated funds for future gratuity payments. This approach not only enhances the security of the benefit but also mitigates the risk of unplanned cash flows. In this video, we will introduce gratuity funding, discuss key considerations for funding decisions, explore various contribution strategies to meet desired objectives. What is gratuity funding? Gratuity funding refers to the strategic allocation of financial resources specifically for the purpose of covering future benefit payments under a gratuity scheme. As organizations evolve, it becomes increasingly common to implement funding mechanisms to manage risks and secure employee benefits more effectively. In India, gratuity scheme funding is generally discretionary. Employers have the autonomy to decide whether to fund the scheme and to what extent. Consequently, trustees and business managers require expert guidance to make informed and rational funding decisions. Having explored what gratuity scheme funding entails, let us now examine the key factors a company should consider when making funding decisions. First factor is local regulations. The gratuity scheme is regulated by the Payment of Gratuity Act, 1972, which includes a provision for compulsory insurance related to gratuity funding. However, this mandate has not been enforced by the central government, rendering gratuity funding non-mandatory on a national level. Nonetheless, states such as Karnataka and Telangana have enacted their own regulations requiring mandatory funding. Companies must, therefore, adhere to applicable state or central laws when determining their contribution requirements. Second factor is outstanding liabilities. Companies should assess the outstanding liabilities of the scheme to guide their investment decisions. The funding strategy should align with the growth trajectory of these liabilities. Third factor is funding level. The funding level is determined by the ratio of scheme assets to liabilities. A scheme is considered partially funded if assets are less than liabilities, that is, less than 100% funding level, and fully funded if assets meet or exceed liabilities, that is, 100% or more funding level. In cases where assets exceed liabilities, the surplus can potentially be used to reduce future contributions or meet future benefits. However, recovering surplus funds from the scheme can be complex. It is prudent to maintain a slightly lower funding level to accommodate unforeseen events. Fourth factor is tax implications. Contributions made to an income tax-approved trust can be claimed as a business expense up to a certain limit. This can assist in managing the company's tax liabilities. Fifth factor is trust fund management. Contributions to the gratuity scheme are typically held in a trust, which restricts the use of these funds to gratuity payments alone. Consequently, companies must carefully evaluate their regular cash flows when determining contribution levels. Additionally, alternative investment opportunities should be considered to optimize capital allocation towards the gratuity scheme. Sixth factor is investment options. The choice of investment fund is crucial. Some funds offer ULIP-based exposure to securities, while others provide fixed returns. Funds may also include implicit or explicit charges, and insurer-based policies generally include term coverage. Companies should carefully evaluate their minimum contributions and potential maximum allocations to leverage market opportunities effectively. These considerations are essential for developing a robust funding strategy that aligns with regulatory requirements and organizational goals. Having explored the key considerations for gratuity scheme funding, let us now discuss several strategies that companies can implement for periodic funding. First strategy is percentage-based contribution. To foster gradual growth of the gratuity fund, a company can adopt a strategy of contributing a fixed percentage of total employee salaries annually. This approach is guided by the unfunded liability, the desired funding target, and the time frame to achieve this target. For example, a company might aim to fund 60% of its liability over a 5-year period. Following an actuarial valuation, the contribution rate might be set at 2% of total employee salaries. This method is straightforward to budget and typically results in more stable financial outflows. It is advisable to review and adjust contribution rates every 4 to 5 years to align with current financial conditions. Second strategy is gap-based contribution. This strategy involves making contributions to cover the deficit between the scheme's assets and the target funding level based on periodic actuarial valuations. When the gap exceeds the target level, additional contributions are made to bridge the deficit. While this approach is conceptually simple, It requires financial expertise and may pose challenges in forecasting and budgeting future contributions. Third strategy is replenishment-based contribution. Under this, companies need to contribute amounts equivalent to past benefit payments made from the fund. For instance, if a scheme with a fund of 5 crore Indian rupees utilized 10 Indian rupees lakh for benefit payments in the previous period, the company would contribute 10 Indian rupees lakh in the next period to replenish the fund. This approach maintains the fund's level but typically does not promote significant growth. It is suitable for companies that do not wish to make substantial investments in the gratuity scheme and prefer to allocate resources elsewhere. Fourth strategy is expense-based contribution. Companies may choose to contribute based on the projected accounting expense of managing the scheme, which includes the cost incurred from benefit accruals. This information is typically derived from the scheme's actuarial report. Funding based on accounting expenses helps address future increases in obligations. Although this strategy is more complex and requires a thorough understanding of expense drivers, it ensures that contributions are aligned with the actual costs of managing the scheme. Each of these strategies has its own advantages and can be tailored to fit a company's specific needs and financial objectives. Evaluating the appropriate strategy requires careful consideration of both current and projected financial conditions. At White Paper Actuaries, we are dedicated to supporting our clients in addressing their actuarial needs with precision and expertise. Our services include a strategic consultation. We offer comprehensive guidance on selecting and implementing the most effective funding strategy for your gratuity scheme. Our team will assist in developing multi-year liability projections, which can help establish a contribution rate linked to employee salaries and aid in business and cost planning. The periodic actuarial valuations. We conduct regular actuarial valuations to provide insights into both funding and accounting requirements. Our detailed reports will outline recommended contribution levels based on your adopted strategy, ensuring that your funding approach remains aligned with your financial objectives. Independent reviews. If your gratuity funds are managed by an insurer, we can perform an independent review of insurer demands. We will analyze the basis of these demands, review expenses related to scheme management, and clarify the segregation of costs for policy renewal versus funding contributions. We are here to ensure that your actuarial strategies are effective and aligned with your organizational goals. Contact us to discuss how we can support your specific needs. We would be pleased to assist with any actuarial valuation needs you may have. We invite you to schedule a meeting to explore our advanced tools and solutions, which are designed to enhance the management of risks and financials associated with your defined benefit schemes.